Here's what's coming up on today's show.
Really, these products are intended to all perform the same over a long period of time, regardless of which index you're using or which method of calculation you're using or how you're limiting the interest on the index contract.
This is the Retire Happy podcast with John Amarino, a fiduciary financial advisor at Securus Financial in the San Diego area, and Thomas O'Connell, president of International Financial Advisory Group, Inc. in Parsippany, New Jersey. Together, they'll be keeping retirement happy from coast to coast.
Welcome back to another episode of the Retire Happy podcast. I'm your host on the West Coast, John Amarino, and I am joined by my esteemed co-host on the East Coast and great friend, Mr. Tom O'Connell. Tommy, how you doing, buddy?
I'm doing great. Once again, John, and totally enjoyed the videos and Facebook info on Jake's MVP award-winning tournament this past weekend.
Yeah, it was a really cool experience. I mean, his coach pulled him aside and just said, you know, we asked you to do everything and you did everything. So, and he hit almost 800. He was on base 9 out of 11 times, pitched lights eye. I mean, it was literally the culmination of all the kid's hard work. I love to say the kid's just naturally blessed. He has phenomenal hand-eye skills, but no one, I think his coach knows and his best friend's parents know, but he's literally works almost an hour a day every day. And for an 11-year-old that in this land of YouTube and PlayStation and Roblox, that's quite the achievement. So
I heard the Yankees, I heard Aaron Boone is overnighting a contract because the Yankee bullpen is so horrible.
Hey, I'll take it. I know they like to overpay. So, but you know, I will say, Tommy, lost in all the glory, and I'm going to give Jake his few days, but your favorite, your little Haley buddy.
Oh, my Haley Bailey.
While Jake is dominating on the field, Bree goes, John, look. And lo and behold, self-taught, she's just riding a bike around the sports complex.
Awesome.
Like literally just, I think she's gone out with Grandma and Papa a couple times at the park, but not within the last month. And she's just cruising around on a bike just in the middle of the sports complex. And I'm like, man, that is her in a nutshell. I thought you were
gonna say Bree said, John, look, and Haley is beating up like 3 boys or something like that.
I would like to say that she'd probably be friends with the boys, unfortunately. So how's school going for Emma?
Oh, going great. She's having the time of her life. So having great classes. They had homecoming last weekend. So she got to experience her first college homecoming. So it's all good. Loving it.
Awesome. And I look forward to seeing you tomorrow night, buddy.
Tomorrow night. Yeah.
This, but being the criminal capital of the world, Washington, D.C., and, meeting up with the good friends. So can't wait to be at Brookstone.
Well, at least we're not in Chicago and have to ask for the non-shooting section.
Yeah, that one was for Derek. So, folks, the last recording we had, we were talking about investing and AI. We're in September, which, Tommy, 51% of down markets happen in September. We're in a late market, positive market, and there's just kind of a lot of headway that we may be facing in the markets. And so we thought now is as good of time as ever to bring on today's guest expert to talk about a financial vehicle that really plays an important role for some retirees. And it's also bantered about type of vehicles. You have your critics and your proponents of it. And, Tommy and I have always pretty much stayed neutral with any investment vehicle. Does it fit into the client's goals, their needs, and is it appropriate? Because there is no perfect vehicle. So with that, I'd like to bring on our host. She's a 25-year veteran of the financial service industry. She's the CEO of Wink Intel, which is a market research firm for insurance and annuities. And it's market research for the consumers and for the advisors. And she is the author of the book, Why I Bought Indexed Annuities. And you can find that on Amazon. And so we are very excited to talk about annuities with our guest today, Miss Cheryl Moore.
And today's guest, the CEO of Wink Intel, it's Cheryl Moore.
Thanks for having me, John and Tom. I appreciate it.
So, Cheryl, it's political season, and in Tom's experience, probably one of the more debated vehicles in this world is the annuity for the client. But in the retirement industry and being retirement specialist, with me having an RMA designation and Tom having his RICP, those are retirement-focused designations. Both those designations tell the advisors, listen, there may be a very important position for an annuity in today's retirees' portfolio. So you being the expert, can you tell us what is an annuity and just kind of the different types of annuities that consumers come across?
Sure. So an annuity is an insurance contract where a consumer pays a sum of money to the insurance company, and the insurance company in turn sends them a paycheck every month for the rest of their life once they're ready to start taking income. There are three main types of annuities. One is fixed annuities, which earn limited interest based on the stock market performance. And the last type is variable annuities, which earn money based on the stock market's performance and also subject you to the potential loss in the market.
Yeah, and you know what I like is the word contract. A lot of people don't understand the importance of that. And there's a lot more paperwork when it goes into an annuity just from, a normal IRA account, because that company is making guarantees based on its claims paying ability to you, the consumer. So that's always a very strong word, contract.
I think it's important too, John, just because a lot of consumers are unfamiliar with annuities. So knowing that there's a contract can make them more comfortable with the concept.
I find that making the equivalent as best as I can for people to understand. Look, so at the end of the day, Social Security is nothing more than an annuity. Instead of sending money to the insurance company, though, you're sending it to the federal government with probably less guarantee of you getting it back than if you sent it to an insurance company. The traditional pension plans, defined benefit plans, are nothing more than an annuity. So when I hear people say, well, I'll never get an annuity, I ask them, well, do you cash your Social Security check? Right? Because at the end of the day, it's the same thing. Am I oversimplifying it?
No, I think you're dead on. Matter of fact, I touch on that in my book, that there are so many vehicles that people are familiar with, which actually are an annuity.
And you know what, Tommy, I actually like the point that you make, that it's similar to Social Security, except for what in Social Security, the government's already telling us you may potentially be taking a little bit of a pay cut. And I have not read any paperwork in any of my annuity contracts where my annuity company said in 2034, you're going to be taking a reduction in your benefits.
Exactly.
You're darn right.
So Cheryl, we've been following you through the different organizations that John and I have been affiliated with, Three Mentors and True Choice, some of the FMOs and other organizations. So we're very familiar with your work. And somewhat of your background. But for our audience, and I know you go through it quite extensively in your book, but why don't you give us a little bit of background as to kind of how you became the nation's annuity expert?
Yeah, you bet. So 25 years ago, I started working for an insurance company, home office, and that company was the number one seller of indexed life insurance in the country. And my job was to do competitive intelligence and product development to ensure that we retained our market share as the number one seller of those products. And when I started working for the insurance company, they enrolled me in this thing I'd never heard of called a 401k. And just to give you some reference on this 401k, I'll tell you, I was a single mom with three babies in diapers because my ex-husband was a police officer who went to federal prison. I was poor. And when I say poor, I mean I was destitute. I was very, very poor. And so when these people with the 401k came talking to me about how this works, they really pressed on the fact that there was a 4% match that my insurance company employer would make on my contributions up to 4%. And everybody said, it's free money. It's free money. You've got to do it. So I did it. And when the dot-com bubble burst, I lost what to me was a lot of money. And it felt very uncomfortable. So I complained to my boss, who was my mentor, and said, this is terrible. Where can I move my money? And he said, well, why didn't you buy an indexed annuity? And I said, what's an indexed annuity? And he says, well, it's a product that'll guarantee you a paycheck every month for the rest of your life, no matter how long you live. And it earns a limited amount of interest based on the stock market's performance, but you can never lose money as a result of the market's performance. And I was immediately intrigued. I said, that sounds great. Where can I buy an indexed annuity? And because of a lot of politics, I'll tell you, I didn't know this, but he stared right at me and said, Cheryl, the company we're employed by is the number one seller of indexed annuities. And so I got a little upset. I got motivated. I decided to go to the library and look up annuities so I could find out where to send my money. And what I found was a lot of negative and inaccurate information on annuities that really disheartened me. And so when I started my own company 5 years later, I decided that I wanted to make sure I was a credible source for all consumers to be able to find information on annuities and decide whether or not they're right for them. I don't endorse any company or product, John. I'm just personally a big fan of indexed annuities.
Now, you had mentioned in our preamble, we were talking about, because I don't want people just to think that, hey, John and I follow you and maybe a few of our friends. You have quite a following.
Yes, 25,000 strong right now.
Yeah, and that's not small.
Well, it's no Kim Kardashian, as I like to say, but I'm working on it.
I don't know who wants to be, but okay.
Yeah, I'm with you on that one. But I mean, listen, 25,000 people, that's a lot of, number one, you're getting your message out to the consumer in a very understandable way. And that's very important because, you have a lot of legalese that have to be written because it's a contract. And you have a lot of, you do have some products out there that just, they're not proper. And, people have to understand the difference between annuities. They're not, one's vanilla ice cream, one's chocolate ice cream. They're two different flavors, two different vehicles. And to have 25,000 subscribers not only tells me that, and then also following you, that you simplify your message, but you're also have resonated as being a very credible source. And that's something that, Tom and I strive for, to be honest. We want to be non-product agnostic. We just want to give people the resources and the information to live a happy life. Yeah. So, I that's big kudos to that amount of success.
Thank you very much, John.
And it's not just the consumer either, right? The industry comes to you for information. So
that's right.
Insurance companies, life insurance companies come to you and say, either ask for you to review their product, or they actually, I think a couple of companies have actually come to you and asked you to help them develop the product, if I remember that.
Dozens of companies since I started in this business so many years ago. But, the main thing is that every insurance company, with few exceptions, works with me and is a client of mine, because we track every single life insurance and annuity product in the U.S., and we report the sales on those products. So it helps the insurance companies know how competitive their offerings are and what markets they might want to get into in the future.
Awesome.
And, Cheryl, you mentioned, and we had talked about the pension Social Security. It's basically your own personal pension, but fixed index annuities also provide a secondary benefit that you briefly mentioned, but it's a powerful product because I actually have it more of a growth vehicle as my principal protected. And that is a fact that, these vehicles that they have principal protection. You cannot lose your money, your principal, to market losses. Can you explain how that happens and how it's tied to the market indexes?
Yeah, so the insurance company really isn't ever investing the client's money in the stock market. They buy derivatives instruments that give them the benefit of earning limited interest based on the stock market's performance. So we'll say the market goes up 20, the client might get 8% or 9%. But when the market goes down, they will never face any losses because the worst case scenario that you can earn on an indexed annuity is 0%. So it's a really powerful story for a lot of people. I think once people are educated on really how annuities work and what they do for them, then they're really intrigued about this type of product in particular.
I'm a big fan of folks like who I know Cheryl, Tom Hegna, Van Miller, yes. And they've taught me over the years that there's nothing more important, I think, for a retiree going into retirement than a guaranteed paycheck. Mm-hmm. Right? And Tom Hegna has written books just around that whole topic. And so for me, in my process of planning for clients and recommendations, that's the main thing that I see these things fitting into is, hey, Mr. and Mrs. Retiree, every day is a Saturday, as Tom Hegna says, when you're retired. And Saturday is the day that you spend your most money, right? And so when you wake up every January 1st, I think one of the most important things to know is that, hey, your monthly bills, or as much as we can get up to your monthly bills, are paid. And so for me, that's what I see those as the main function for.
Yeah, I agree with you, Tom. Most people don't have any idea what an annuity is or what it does. But when you explain to them that it can help make sure to cover all of those expenses that they need to account for in retirement, and it'll guarantee them a check for that amount every month, even if they live to be 150 years old, then people really get excited about that.
Right. Yeah, and you can't outlive it.
That's right.
And, I know, Tom, you do a ton of reading, probably do more reading than I do. And I am often on planning forum boards, reading about, some great ideas out there. And this has always been a contested vehicle. People saying, well, I can develop this ladder. I could do this. We could do more with annuities. They're expensive vehicles. But Tom, Cheryl, tell me if I'm wrong, that 85 to 90% of this game is psychological.
Oh, absolutely.
When things are going good, everybody wants every bit of the S&P 500. And when things are going bad, they want none of it. And, I just peel back and I just look at it from a psychological standpoint. My happiest clients in 2022, 2020 were those that had index annuities, especially those who were collecting the income. Because when they were watching the markets plummet 30+% in COVID and 60-40 portfolios be down 25%, they saw the same paycheck as advertised. And, Tom, you mentioned Tom Hegna, and I'm going to take it one step further. Our good friend David Gaylor with income allocation. That's the one thing those gentlemen taught me, that psychologically people want to replicate what they've known. And what they've known their whole life is that paycheck. And that's really what I've seen the annuity provide, that, everybody loves the all-weather portfolio by Ray Dalio. This is really the all-weather income stream, no matter what the markets do. So with that, can you just briefly talk about, because I think for a lot of people, when you mention the word annuity, they might think of their grandpappy's annuity, which
Where are you from, Graham Pappy?
settle down, Jersey. So, where it was, well, he left a $200,000 annuity. He got paid out. It was on a lifetime income stream only. He died 3 years into it, and the insurance company kept all the money. Can you kind of talk about the evolution of that into today's annuity?
Yeah, that's a good point, John. So initially, back in the days of the Romans, there were immediate annuities, which commenced income right away. And we still have those types of immediate annuities today, but not a lot of people buy them because they're very rigid and they just don't offer you the flexibility that products like indexed annuities do. But the way those work is you have several different options for taking payments out of it. And one of them is for the rest of your life, no matter how long you live, even if that's 2 years into the contract. So that's one option on one type of annuity. But what's interesting is indexed annuities and other types of deferred annuities like fixed annuities pay the full account value upon death to your beneficiaries. So if your annuity contract was worth $150,000 and you died, your beneficiaries would get the $150,000 plus interest.
Now, when you're getting the income, right? So you said that even if you live to 150, right? Well, if I've collected for 20 or 30 years, then obviously I've gotten more back from the insurance company than the value of my contract. So at that point, somebody might end up with a zero as a beneficiary.
That's right. Once you start taking income, that is possible.
But on the other hand, you've gotten way more than you've put into it, as the consumer or the owner of that contract.
That's right.
So Cheryl, can you tell us as a consumer advocate on annuities, I have some pretty stringent requirements myself, and I know Tommy does too when it comes to insurance companies. I have kind of gone round and round with some reps over the years who have tried to put my clients in, triple B rated companies. I want A- or above. I want that superior company because that is the one true risk. But as a consumer listening to this, can you give us some tips as to what they should be looking for in the annuity itself to provide and some things to be aware of?
Well, I always think an important provision to look at is anything you're unfamiliar with when it comes to annuities. I mean, there's no such thing as too many questions from a consumer advocacy standpoint, but you touched on something that I really like to point out, and that is the death benefit on the annuities. The other thing I like to encourage people to look at is the withdrawal provisions, or how much money can you take out of the contract each year without being subjected to surrender penalties. That's ordinarily 10% of the annuity's value, but it can differ based on the product. So it's something you should look into. There's so many features that are specific to indexed annuities, like how is the index return calculated? What index are we using as the benchmark for earning interest? Is it the S&P 500 or the Dow Jones Industrial or XYZ exotic index? Those are all important things to look into. But at the end of the day, you have to remember, does this product guarantee me my income that I'm looking for? And when it comes to index annuities, the answer is going to be yes across the board.
Now, do you find that, because I've heard the argument both ways, I'm very pro income rider, because it creates a minimum guarantee that someone will obviously get as it, and those riders are typically more flexible than, say, the standard amortization of an annuity.
Yes.
Right. So what are your thoughts on that?
Well, like you, I'm product agnostic. I actually developed income riders back in 2006 because I saw that annuitization, which is the traditional way of creating a paycheck for life for the client, was just not popular. Nobody talked about it. And the real reason for that is that it's so structured and inflexible. If I annuitize my annuity and they say I'm going to earn $563.33 each month, I'm locked in at 563.33. Let's say somebody hits my car, I get in a car accident, I need an additional $500 to pay my deductible. Well, you can't do that with annuitization, John. You get your 563.33 every month until the day you die. With an income rider, you retain that flexibility. You can take out the extra $500. Now, there will be some penalties that you're subjected to, but it's a product that has much more flexibility than annuitization. And the great thing about income riders is your family still gets the remaining benefit in the annuity, and you retain that flexibility.
And, the big thing too is, and I know Tommy and I both position our annuities this way, right? Income allocated. We're income allocated, and we're giving you, whether the client wants it just for basic retirement expenses or if they want their lifestyle expenses built in. But, insurance companies, they make sure that you have other assets available when you're going through your suitability process. And really any advisor worth their salt should say, listen, this is a portion of your portfolio. We're not you don't put all your money in this. And, for Tommy and I know we have other investments that, hey, if inflation gets a little out of control, like we've seen, we have other investments that, we can hedge, or we can hedge with an emergency cash reserves. And, that's important for people to understand, is you don't put everything in this. And I actually like how you brought up the market indexes, because right now, being a little bit critical of a lot of companies, their exotic indexes have not been worth a damn. We saw they had a couple of good years, but it's really kind of been the bread and butter of just, here's your S&P 500, your NASDAQ, your Russell indexes.
Well, there is an extra layer of due diligence that goes into selling those index annuities with exotic indexes, because you have to not only research the annuity, but you have to research the index as well, where when you talk the S&P 500, most everybody is familiar with that index. So it's just an extra layer of due diligence for the advisor.
When again, in my process with people, kind of talking to what John was just saying, is I look at these as the equivalent of building your foundation of your house.
Mm-hmm.
Right. So this and your life insurance, because I'm a big life insurance proponent. Everybody knows that, especially cash value. But, somebody just doesn't have a house that's a foundation. Mm-hmm. You have walls and floors and roofs and blah, blah, blah. Right. So again, these are these are some of the most important pieces or elements of your plan, because it allows for you to have a floor and a ceiling and a roof and so on and so forth. So, I'm going to go off the board a little bit, Cheryl, and throw maybe a little bit of a curveball to you.
Okay.
So we are expecting an interest rate cut from the Federal Reserve. Mm-hmm. How do you think, or what has been the history of interest rate cuts and or rising interest rates from the Federal Reserve on these types of products?
So fixed and index annuities have an interest component that is based on Moody's Baa1. The 10-year Treasury is a good benchmark for what interest rates are going to be like on these products. And I will say that historically, when the Fed has dropped rates, that also makes annuity rates less attractive when we're talking about fixed and index annuities. And then when the Fed has increased the rates, those have had a positive correlation on rates with those types of annuities. I'm personally a little conflicted because, I do some real estate investing. I don't like mortgage rates being as high as they are. So in that sense, I kind of want them to make a 0.5% reduction in the Fed funds rate. But the annuity lover in me really wants rates to stay high the way they have been for, the past few quarters. And I'd love to see them just drop it 0.25 point. But I guess we'll find out on Wednesday, right, Tom?
Right. Now, I guess the way the annuity is built, the indexed annuities, it becomes a little slightly more expensive of a product internally, because those hedgings or those derivatives that they're buying cost more, right? Because these companies have to have more money in their capital reserve from your premium, blah, blah, blah. And so I want folks to try to understand that there is a rhyme and a rhythm to this.
Mm-hmm. Well, the stock market's performance definitely affects the insurance company's investments and how they make that indexing mechanism work. But the great thing about the products is that you're never directly invested in the index. So you're protected by that 0% interest on the downside. And I would say, just for those, let's say we have some engineers that are on the line and want to know more. I mean, really what you need to understand is that the insurance company takes 95% of your money and puts it in bonds, but then the other 5% or so they're going to use to purchase options, which are those derivative products that provide the index linked interest.
And, you brought up, how investments affect the insurance companies, and probably, the biggest concern from, any prospect or client that I talk to about this is like, well, what if that insurance company goes belly up? And we try to make the explanation. Listen, a lot more banks have gone under than insurance companies, but it's also a reason why I choose, A- rated companies and above. But can you talk about just the capital that these companies have to have with each state? And I mean, I'm not saying it's not out there, compliance. I'm definitely not saying this, but I have not been able to find an A-rated company that has gone under or not been able to pay out its benefits, or has not been acquired by another company that has not paid out the benefits. Can you speak to any of that?
Yeah, so the insurance companies have to hold money on reserves to make sure that they're able to pay out every claim they have at the same time should a disastrous event occur, and make sure that they have the money to pay the claims for any annuitants or insureds, which are people who buy life insurance. And the insurance regulators, now there's 50 of them because this is a state regulated business rather than a federally regulated business, but the state regulators do regular checks on the insurance companies to make sure that their balance sheets look good. Now, in the event there was an annuity company who was at risk of bankruptcy, what would happen is the insurance commissioner would come in, try and fix things on their own. If that's not able to be done, then they would go out and ask other insurance companies if they would be willing to buy the insurer who's in financial difficulty. And if that doesn't work, then they use something called a guarantee fund association in order for everybody to get back their money up to usually a $250,000 limit. So I like to tell people, if you're familiar with the FDIC with banks, the guarantee fund for life insurance and annuities works similarly.
But better funded, right? Because the like you said, the insurance companies have to have capital reserves to pay claims, whereas the FDIC, as I recall from my last reading, only has to keep 7 cents on hand for every dollar that they owe. Thus, in 2008, the huge bailout of the federal government for the FDIC, which was quite literally hundreds of millions of dollars or hundreds of billions of dollars.
Well, what's interesting, Tom, is when the market collapsed in 08, 09, I think we had over 300 banks that failed, and there were only 3 insurance companies that sold annuities that needed help during that period.
And I can remember getting a letter from the state of New Jersey Department of Insurance saying, AIG Life Insurance is still an A+ rated company. Don't you dare replace those products.
That's right. Well, that's a huge misunderstanding, just because most people think of AIG as an insurance company, but they have a lot of different facets to their business.
It's all those subsidiaries, the locomotive leasing, insurance, blah, 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 all that other nonsense that they're ancillary businesses. The life insurance unit was still, and I think to this day is still rated A+.
So Cheryl, so kind of, I want to circle back to one of my questions a little bit ago. So what do people who are getting into an index annuity, what are some of the things that they really have to understand and be aware of it? And I'm talking about, and you'd mentioned it, but can you explain what a surrender period is? And, a lot of these writers, and it's one reason why I'm not a fan of variable annuities, is the amount of rider fees and the costs that could be upwards of 3% annually. But the rider fees that go into some of these income benefits that are reasonable, and is the rider fee on the accumulation side or the income side? Can you just some things that people could easily glance over, but it's important to understand because every dollar is worth something.
Sure. So almost every annuity has what's called a surrender charge, which is basically a way of disincentivizing the client from taking out more money than anticipated at any given point. And that's just because when you buy an annuity, the insurance company's going out and let's say it's a 10-year annuity. So they're going out and buying 10-year grade A rated bonds. And if you cash out early or take more money than they had anticipated you would, then they're going to take a hit on it. So the surrender charge is used to just kind of disincentivize that kind of behavior from the client. I would say an average surrender charge lasts 10 years, and the penalty for the surrender charge decreases usually every single year. So your penalty in the first year might be 10%, but in year 2, it would go down to 9 and then 8 and et cetera. So surrender charges are definitely something that a prospective purchaser should be investigating. And it's so important to the insurance industry that they put it in a certain size of font, in fact, just to make sure that the consumer is aware of it. Riders or income riders or guaranteed lifetime withdrawal benefits, these are all the same thing. They do usually have a fee that's associated with them just because it costs the insurance company money to provide that flexibility in the income payments. But there's 2 ways of charging for it. One's more predominant than the other, and that is charging based on the value of the income rider, which is normally greater and sometimes as much as 200% greater than the account value on the contract. But there are some annuities that have income riders, which are still based on that lower account value. Just note that those fees normally have to be higher than their benefit-based driven brethren, just because that account value is lesser than the benefit-based value of the income rider. So those are important to understand. And any fees on any annuity are something that should be investigated closely. And if there's more than one fee, you need to be able to see clearly how much are the total fees on this contract. But most products, John, don't have fees on them. Just the income riders almost always have a fee that's associated with them.
Unlike the variable annuities, as you were mentioning, John.
Yeah.
Yeah. Well, that's another whole
That's
other
a whole different podcast.
Well,
we're big fans of them.
And Cheryl, I mean, you've hit just on so many important topics, and I always tell people, listen, annuities. Another thing that differentiates an annuity from an investment vehicle is not only the contract language, but the fact that and you're going to probably know it better than Tommy and I, that the annuity and life insurance companies employ people called actuaries. The life of the party people. And a lot of this is based on math. And that's really where the surrender schedule comes, because to provide these benefits and guarantees, they have their mathematical equations built in. And, that's why they know certain part of the, statistically speaking, X percentage of the population is going to live to 80 and X percentage is going to die before 80.
That's right. And those people are certainly smarter than I am, John.
And they have millions of pieces of data.
Yes.
Over a historically long period of time to work with. I think I find that with the investment choices within the index annuities as well, right? Whether it's an annual point to point, a monthly point to point, a participation rate, a cap rate, those are all done by math. And at the end of the day, I think over an extended period of time, they're all trying to get you to the same place.
Yes.
Right. But people look at returns differently. So they're really trying to just, I think, appease a broad spectrum of the consumer by having those options. Is that pretty accurate?
Yeah, it is. I would add too that the reason why there's so many different options when it comes to indexed annuities and the crediting of their index interest is because insurance companies wanted to keep insurance agents engaged and give them something new, something different to get their attention. Because independent insurance agents can sell any insurance company's products that they want as long as that company distributes through independent agents. It's very unlike, let's say, I don't even know if you guys will allow me to say insurance company
You can
names.
say whatever you want.
Okay, so
Our
like,
compliance will just edit it out if they
Yeah,
don't.
our
like it. You
compliance
say
will
whatever
edit
you
it out.
want.
Yeah.
well, like a New York Life or a Northwestern Mutual,
Right.
where their insurance agents are employees of the insurance company and cannot sell any other company's products with few exceptions, which really cuts down on the ability to offer competitive products to their clients. That's the reason we have so many choices. And like you touched on, Tom, really, these products are intended to all perform the same over a long period of time, regardless of which index you're using or which method of calculation you're using or how you're limiting the interest on the index contract.
Good.
Yeah, and I believe the word that's commonly used for the New York Life or the those singular agencies are captive.
That's right.
Insurance agents. And I think one other point needs to be made, and Cheryl, I think you'll agree with this, is listen, we've mentioned stock market indexes. We've mentioned the Russell, the NASDAQ, and the S. These are not meant to, keep up with the stock market. They are not meant to do that. They just give you the ability to participate in some of the growth of those.
Mm-hmm. Yeah, I mean, when the insurance company first developed an indexed annuity contract back on February 5th of 1995, there was some misunderstanding with consumers that these products would provide equity-like returns, and that's because we called them equity indexed annuities. But we dropped that equity nomenclature from the product so that there would not be any mistakes that this is not an equities product. You cannot get stock market-like performance with indexed annuities on a regular basis. Now, that said, I am going to say, John, at the end of my book, you can see a lot of real-world examples of people who got home runs. So it is possible. It is not a reasonable expectation for gains on a linear basis.
Yeah, I think the idea really is to give the consumer an opportunity to quote unquote, I'm using air quotes for those folks who are listening,
Yes,
the ability to beat fixed rate returns, maybe by a couple of percentage points, right? It's not to get what the S&P 500 does.
You're making me happy, Tom, because there are
plenty
of people who describe how these products work inappropriately. What I have always told people is they are intended to outperform fixed annuities by 1% to 2%. So if you go out and find out, you can even find out on bankrate.com what average annuities are crediting for fixed annuities. Just take that and ask yourself, is 1% to 2% better than this something that appeals to me? And know that the worst case scenario is 0%. I think that story resounds with a lot of people, John. And I would tell you the people who earned 40% plus that have their statements in my book are more than happy.
And even Wade Fowd has, in his research, has said that, especially in lower interest rate environment, that these are excellent bond or fixed income replacement products as well.
Absolutely.
Well, that was, we blew through that time, I think, as we always do. But again, I mean, what a great discussion on a vehicle that is very popular, I would say, amongst the people that have them, and confusing to those who don't, just because of, like you mentioned in the beginning, the whether it's the variable annuity world, which can have some effect on index, universal, or even fixed annuity prospects. And I appreciate you coming on and just simplifying things for us, Cheryl. And we made reference to your book a couple of times, and it's a phenomenal book. It's an easy to read book. It's Why I Bought an Index Annuity, folks. It's on Amazon. We'll have the link in our show notes. If you're talking or you're thinking about the need for an annuity, I highly encourage you buy this book. It's going to give you a great perspective on this. And if you want even more information, you can visit Cheryl's website, winkintel.com. We'll have that in the show notes soon. Cheryl, is there anything else you'd like to say in closing?
No, I'd just like to say, although I don't endorse any company or product, I am a huge fan of annuities because the number one fear of Americans is running out of money in retirement, John. I mean, that's a bigger fear than death or public speaking. And it just seems so simple to me because an annuity can guarantee you a paycheck for the rest of your life, even if you live to be 150 years old. So it seems like these products are strategically positioned to overcome the number one objection of Americans when it comes to retirement. And I just want more people to know about them and be familiar with how they work so that they can decide for themselves whether or not they're right for them.
Awesome. John, I know our podcast is audio only, but I want our audience to know that I very much appreciate your 1970s polo shirt that you're wearing on this broadcast. I'm not sure if you pulled it out of your grandpappy's closet, but it's a beauty.
Yeah, it's called Travis Matthews. I know you're still wearing Z Cavarici from the 80s. Folks,
Members
I
only.
promise you, I'm going to make this. If I can make it happen before I get on the plane tomorrow, I promise the listeners of this podcast, I'm going to get a straw hat and a smoking pipe. And I'm going to wear Tom. I'm going to have Tommy wear it in DC because then he will look like a grandpappy.
I'm the last member. Remember, from members only. So
that is true. True statement. So, well, folks, that wraps up another episode of the Retire Happy podcast. Again, thank you very much to our guest, Cheryl Moore.
Thanks, Cheryl.
On simplifying and often confusing, but very valuable financial vehicle. So we hope you enjoyed the show, and we hope you are having now the end of a great summer as we now switch into fall, and we hope you are retiring happy. Take care, folks.
It's easy to get in touch with John and Thomas. If you're more on the West Coast, give John a call at 858-758-9889. That's 858-758-9889. Or go online to GoSecurus.com. That's GoSecurus.com. If you're more of an East Coaster, then call Thomas, 973-394-0623. That's 973-394-0623. And online at internationalfinancial.com. That's internationalfinancial.com. And you can, of course, always just check the description of today's show for all that contact information. Don't forget to subscribe and follow the podcast on your favorite apps, and we'll see you next time on the Retire Happy Podcast.
Investment advisory services offered through Brookstone Capital Management, LLC BCM, a registered investment advisor. BCM, Securus Financial, and International Financial Advisory Group are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by John Iamarino, Thomas O'Connell, and guests on this show are their own and are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and, unless otherwise stated, are not guaranteed. Past performance cannot not be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it is suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to the subjects covered. Registered investment advisors and investment advisor representatives act as fiduciaries for all of our investment management clients. We have an obligation to act in the best interests of our clients and to make full disclosure of any conflicts of interest, if any exist. Please refer to our firm brochure, the ADV 2A Item 4, for additional information.